So welcome again. Today let's learn how to use a Safaricom green board or medium term notes to build a share portfolio. And it's the same thing if you have already applied for EABR medium term note board, it's the same thing you can use to build your share portfolio. My name is Peter Chege. That's my WhatsApp number. You can check my YouTube channel, my Wealth Guide KE, the Gentasad Studio for more details. Also, in the description of this video, you can get links to my various social media accounts where you can get more details. And also on my blog, where I post additional materials. So, why does this strategy work? Which strategy are we talking about? Using interest from the board to build a share portfolio. So most people struggle to buy shares consistently. And most trades, because by the time you want to buy it, you don't have those funds. You already have Safaricom board, which is closing this Friday, which is giving you guaranteed cash twice a year. That is, you apply for the board, you loan your money to Safaricom, they have guaranteed you they'll be giving you 10.4% interest, which is tax free. There is no withholding tax. So you're getting money as it is twice a year. So it is semi-annual, June and December. For EABR again, it was the same, May and November. So if you applied EABR and you also applied Safaricom, so May, June, November, December, you have some cash coming in. But for EABR, remember it attracts withholding tax. So you can convert this cash that is paid directly to you, their interest, into shares during those months. Why? You notice around May, June, there are those companies that announce dividends and the book closure within June, July, August. You can buy those with this interest. In December, when you receive, there are those companies that announce early January and March. Before prices go up, immediately you receive. When prices are down, buy. When others are struggling to chase the prices, you have already used interest, which is free money. But remember, Safaricom, when you loan them your money, so let's start with understanding this board. You loan them a minimum of 50,000 upward, graduated in 10,000. They have promised you per year they're giving you 10.4% interest. It's called coupon. It doesn't attract any withholding tax. Meaning, you multiply the amount you're giving to them times 10.4. That's the amount you get per year. You divide that by 2. So in June, you get part of that. December, you get that. It is starting, the payment is starting June 2026. Sorry, in the previous video, I said it is December, but that was an example how you can use that interest to buy dividend stocks. But in real sense, it will start June next year. 2026, that's when the first payment will be made. So if you're giving 50,000 and you multiply by 10.4%, so in a year you're getting 5,200. You divide that by 2, 2,600 in June, the other 2,600 in December, paid directly to you. Then at the end of the board, the 5 years, 2030 December, you get back your 50,000 intact. There is nothing that is deducted. So then how do you make this board your income engine? It comes to step 2. So you have step 1, we have given our money. Step 2, interest is guaranteed every 6 months. Your capital, as I've said, it will be returned 2030 intact. You have predictable cash flow. You know even when this money is coming, June, December. Your board now becomes a free money generator for buying shares. So June, you have money to buy shares. December, you have money to buy shares. If you bought EABR board, May, you have money to buy shares. November, you have money to buy shares. There is no need of touching your salary that month. You are actually reinvesting those coupons into shares. So you are recycling your coupons into another asset called shares. When you buy shares, you're buying ownership of a company. When company makes profit, they give you dividend. Dividend is another free money you are receiving. So you're investing free interest into another dividend stock to give you another free dividend. So free interest gives you free dividend. So you use every payment to buy shares in strong dividend paying stocks. And as I said, if you're targeting cheap stocks, penny stocks, only to give dividend. Kenyali, CIC. The others they don't give. The other expensive stocks, I have full list of the stocks that give dividend and when they give. You can check on my blog or you can reach out on my WhatsApp if you need that list. It's free. So small consistent buying equals to long-term compounding. Also, what is happening? You have reinvested this interest into dividend stocks. This dividend, when it comes, don't use it. Reinvest again. You are compounding. Over time, you start seeing returns. So then how are you building two income streams? The first income stream is bonds interest. It is guaranteed June, December, May, November. The second income stream is share dividend. You're using this bond interest to buy into dividend stocks. So you buy the stocks that give dividend next. When you receive that dividend, buy another stock that is giving dividend next. That is whose book closure is after you receive your dividend. You continue like that. Banks, Safaricom and other stocks, they pay annual, the others semi-annual, the others which give special dividend. Those are the stocks you want to target. So your dividend buys more dividend shares. These shares also appreciate in value. You can sell at a profit called capital gains without any tax paid. So your wealth machine, which is a compounding cycle, is your board pays you interest, you buy shares grow in value, these shares give you dividend, you buy into more dividend stocks using the dividend, you repeat that over time, your interest plus dividend plus growth multiplies into a growth portfolio. You have a very huge portfolio that translates into wealth building. So that's how you can use interest to buy dividend stocks. Now, in terms of returns from your board, if you put 50,000, this is the amount you can get. Every 6 months, 2,600. Interest, total interest per year, 5,200. In 5 years, you have earned 26,000, which you can reinvest in shares. 100,000, 5,200. In a year, 10,400. After 5 years, you have 52,000. You have reinvested this in shares. 1 million, the same thing. You have reinvested 500,000, 520,000 into shares. And remember, your 1 million will be returned. If you're putting 10 million, you have reinvested 5,200,000 into shares, dividend stocks. Then in 5 years, your 10 million is returned. That time you come now and buy more dividend stocks. So apart from 5,200, 5,200,000 you have used to buy dividend stocks, your 10 million now comes and buy additional dividend stocks. And you continue now earning dividend just from a single decision that you make today, buying that board. It is giving you returns. Those returns accumulate now, start building. Remember, it's not only that interest you're putting, there is that dividend that's coming which you're putting back. Then when your principal is returned, buy now more dividend stocks. You have built a portfolio that can serve you in your retirement. That's what I usually call wealth building. That's why my channel is called My Wealth Guide, KE, the Jantasat Studio. You can check more videos on my YouTube channel, and remember to subscribe and follow for more. And you can always reach out to my WhatsApp number. That's my WhatsApp number in case you need anything. Let's meet in the next one where now we expound into these details. And remember, still on these platforms and YouTube channel, I'm doing beginner friendly from scratch so that you understand shares, boards, and also international markets, shares there, physical shares, fractional shares, ETFs, fractional ETFs, gold, crypto, and everything that trades in international markets, including Forex. So let's meet in the next one. Thank you.